Welcome to Vorldrevolution. Dear friends, today we will share example from 7 lessons from Tony Robbins' book Unshakeable for non-financial personnel. Lesson No. 1. Being Presence. Tony had shared the meaning of unshakable as a state of mind that will help you unwavering confidence even amidst the storm. When others are afraid, you have the presence of mind to take advantage of the turmoil swirling all around you. This state of mind allows you to be a leader, not follower. To be the chess player, not the chess piece. To be presence, you need to break the fear since fear isn't rewarded. Courage is. Nelson Mandela had shared, I learned that courage was not the absence of fear, but the triumph over it. The brave man is not he who does not feel afraid, but he who conquers that fear. Tony had put a question: does being fearless mean having no fear? No. It means fearing less. And concluded that if you live in fear, you've lost the game before it even begins. Presence is always connected to patience. Greed and impatience are dangerous traits when it comes to investing. We all have a tendency to want the biggest and best results as fast as possible, rather than focusing on small, incremental changes that compound over time. Warren Buffett has shared, the stock market is a device for transforming money from impatient to the patient. My lesson was being present in every moment of your life. As I had mentioned in my previous article that I had found Presence book for Amy Cuddy is the best book that I have read on 2016, and here Tony Robbins confirmed the importance of being present. Example 1. The Calm Investor. Robbins shares the story of an investor who learned to stay present and calm during market fluctuations. This investor used to react impulsively to market news, often buying and selling based on fear and excitement. However, after adopting mindfulness practices, such as meditation and deep breathing, the investor was able to remain composed during market downturns. By staying present and not letting emotions dictate their actions, the investor avoided panic selling and instead took advantage of buying opportunities during market dips. This example illustrates how being present can lead to more rational and profitable investment decisions. Example 2. Mindful decision-making. Another example Robbins provides is of a business owner who applied the principles of mindfulness to their decision-making process. This individual used to make hasty decisions under pressure, often leading to suboptimal outcomes. By practicing mindfulness, the business owner learned to pause, reflect, and consider all aspects of a situation before making a decision. This approach not only improved the quality of their decisions but also reduced stress and increased overall satisfaction. This example highlights the benefits of being present and making thoughtful and well-considered choices. Example 3. Reducing stress and anxiety. Robbins also discusses the impact of being present on reducing stress and anxiety. He shares the story of a professional who was constantly worried about the future and regretting past mistakes. This chronic stress affected their health and productivity. By incorporating mindfulness techniques, such as focusing on the present moment and practicing gratitude, the professional was able to shift their mindset. They became more aware of their thoughts and emotions, which helped them manage stress more effectively and improve their overall well-being. This example demonstrates how being present can enhance mental and emotional health. Example 4. Enhancing relationships. Being present also plays a crucial role in improving relationships. Robbins tells the story of a couple who struggled with communication and connection due to their busy lives and constant distractions. By committing to being fully present with each other, such as setting aside dedicated time for meaningful conversations without interruptions, they were able to strengthen their bond and deepen their understanding of each other. This example shows how being present can foster stronger and more fulfilling relationships. Example 5. Achieving work-life balance. Finally, Robbins emphasizes the importance of being present in achieving a healthy work-life balance. He shares the story of an executive who was always preoccupied with work, even during family time. This led to feelings of guilt and dissatisfaction. By practicing mindfulness and setting clear boundaries between work and personal life, the executive learned to be fully present in each aspect of their life. This not only improved their relationships with family and friends but also increased their productivity and satisfaction at work. This example illustrates how being present can lead to a more balanced and fulfilling life. Unshakeable highlights the profound impact of being present on various aspects of life, from investing and decision-making to stress management, relationships, and work-life balance. Through real-life examples, Robbins demonstrates how mindfulness and presence can lead to greater financial success, emotional well-being, and overall fulfillment. Lesson No. 2. Focus on what you can control, not what you can't. The first question that every great investor asks constantly is this: how can I avoid losing money? This may sound counterintuitive. After all, most of us focus on exactly the opposite question: how can I make money? If you know your limitations, you can adapt and succeed. If you don't know them, you're going to get hurt. Ray Dalio. The lessons is: be grateful for what you have and ensure to focus in what you can control, not what you can't. In Unshakeable, Tony Robbins emphasizes the importance of focusing on what you can control and letting go of what you can't. This principle is crucial for maintaining a calm and rational approach to investing and life in general. Let's explore some deep examples from this section to understand how this mindset can be applied effectively. Example 1. The Resilient Investor. Robbins shares the story of an investor who experienced significant market volatility. Initially, this investor would react emotionally to market swings, constantly checking their portfolio and making impulsive decisions based on short-term fluctuations. However, after adopting the principle of focusing on what they could control, the investor shifted their approach. They started focusing on their long-term investment strategy, regular contributions, and maintaining a diversified portfolio. By letting go of the uncontrollable market movements and concentrating on their own actions, the investor achieved more stable and consistent returns. This example illustrates how focusing on controllable factors can lead to better investment outcomes. Example 2. Managing Personal Finances. Robbins recounts the experience of a family struggling with debt. They were overwhelmed by the amount they owed and felt powerless to change their situation. By focusing on what they could control, such as creating a budget, cutting unnecessary expenses, and increasing their income through side jobs, they gradually paid off their debt. This shift in focus from the daunting total debt amount to manageable daily actions empowered them to take control of their financial future. This example highlights the power of focusing on actionable steps rather than being paralyzed by the magnitude of the problem. Example 3. Navigating Career Challenges. Another example Robbins provides is of a professional facing uncertainty at work due to company restructuring. Instead of worrying about potential layoffs, which were beyond their control, the professional focused on enhancing their skills, networking, and exploring new opportunities. By concentrating on self-improvement and proactive career management, they were able to secure a better position, either within the same company or elsewhere. This example demonstrates how focusing on personal development and actions within one's control can lead to positive career outcomes, even in uncertain times. Example 4. Health and Wellness. Robbins also discusses the importance of focusing on controllable aspects of health and wellness. He shares the story of an individual with a family history of heart disease. Instead of worrying about their genetic predisposition, which they couldn't change, this person focused on maintaining a healthy lifestyle through regular exercise, a balanced diet, and regular medical checkups. By concentrating on these controllable factors, they significantly reduced their risk and improved their overall health. This example underscores the value of focusing on proactive measures rather than fixating on uncontrollable risks. Example 5. Emotional well-being. Finally, Robbins emphasizes the impact of focusing on what you can control on emotional well-being. He tells the story of someone who was constantly stressed about global events and economic uncertainties. By shifting their focus to what they could control, such as their daily routines, personal relationships, and self-care practices, they were able to reduce anxiety and improve their mental health. This example illustrates how focusing on controllable aspects of life can lead to greater emotional stability and resilience. Unshakeable provides practical examples of how focusing on what you can control, rather than what you can't, can lead to better outcomes in various aspects of life. By adopting this mindset, individuals can achieve greater financial stability, personal growth, health, and emotional well-being. Through these real-life stories, Robbins demonstrates the transformative power of focusing on actionable steps and letting go of uncontrollable factors. Lesson No. 3. Enhance your decision-making skill. Either you master your mind or it masters you. Our lives are shaped not by our conditions, but by our decisions. Decision-making is a skill that not only financial personnel needs to master but all professionals and even the people who look to have a better life, which needs better mind state. Tony wrote, the single biggest threat to your financial well-being is your own brain. Human brain is perfectly designed to make dumb decisions when it comes to investing. Thus, the brains are developed to avoid pain and seek pleasure. We yearn for whatever feels likely to be immediately rewarding. Needless to say, this isn't always the best recipe for smart decision-making. Tony had referred to few psychological phenomena and biases that affected the decision of the financial advisors, which will reflect on the market. In the book, most of the phenomena and biases were supported with examples. Like Bogle had mentioned, Tony, if you pack 1,024 gorillas in a gymnasium and teach them each to flip a coin, one of them will flip heads 10 times in a row. Most would call that luck, but when that happens in the fun business, we call him a genius. Here below are some of the examples. Behavior finance, which explores the cognitive biases and emotions that cause investors to act irrationally. Endowment effect, in which investors place greater value on something they already own, regardless of its objective value. Warren Buffett, investors project into the future what they have most recently been seeing. That is their unshakable habit. Recency bias, recent experience carry more weight in our minds when we're evaluating the odds of something happening in the future. Home bias is psychological bias that can affect the investing options, where people tend to stick with whatever they know best, preferring to trust what's most familiar. That leads people to invest disproportionately in their own country's markets. Negativity bias, human beings have a natural tendency to recall negative experiences more vividly than they do positive ones. Loss aversion is a mental phenomenon, which been introduced by Daniel Kahneman and Amos Tversky, which demonstrate that financial losses cause people twice as much pain as the pleasure they receive from financial gains. Overconfidence is a psychological bias that we consistently overestimate our abilities, our knowledge, and our future prospects. Humans have a perilous tendency to believe that they're better, or smarter, than they really are. Confirmation bias, which is the human tendency to seek out and value information that confirms our own preconceptions and beliefs. Our brain is wired to seek out and believe information that validates you owning it. After all, our minds love proof, especially proof of how smart and right we've been. Investors often visit newsletter and message boards that reinforce their beliefs about the stocks they own. Finally, Tony had concluded the best formula for having better brain, thus having better decision. Trust your heart. It knows what to do. Your heart and mind aligned are a powerful force. When unified, they're unbeatable. Personally, I fall in love with economic behaviors. I read many books in the past 4 years, and I was right and strengthened my skills in that subject. Still, I am looking for more. This book gave me the boost to strengthen my skills in that subject and enhance my decision-making process. Lesson No. 4. Anticipation is power. Franklin had said, by failing to prepare, you are preparing to fail. Tony Robbins had shared at the introduction that knowledge is only potential power. Knowledge is your first defense. He defines power as the ability to shape and influence life's circumstances. The fuel to produce extraordinary results. Why prediction is important: because we're not rewarded when we do the right thing at the wrong time. Therefore, if you can't predict the future, the most important thing is to admit it. Unshakeable will show you how the masters of the financial world prepare themselves. As a result, you'll be able to benefit from the very thing that harms those who are unprepared. Moreover, the book will help you to figure who you can and cannot trust. Winter is always followed by springtime, and sometimes the seasons turn much quicker than you'd ever guess. What separates the money masters from the crowd is this ability to find a winning strategy and stick with it, so the odds are always strongly in their favor. The lesson again is prediction is a power. Tony Robbins, through his books and audiobooks, keeps reminding us for the importance of the prediction, had helped me to enhance my power of prediction. Even I wrote an article with title, "We Can't Live in Yesterday's Standard and Expect to Be a Winner Today." Tony Robbins emphasizes the concept of anticipation is power, highlighting the importance of being prepared for various financial scenarios. This principle is about foreseeing potential challenges and opportunities and taking proactive steps to navigate them effectively. Let's explore some deep examples from this section to understand how anticipation can empower investors. Example 1. Preparing for market corrections. Robbins shares the story of an investor who understood that market corrections are a natural part of the financial cycle. Instead of fearing these downturns, the investor anticipated them and prepared by maintaining a diversified portfolio and keeping a portion of their assets in cash. When a market correction occurred, this investor was able to buy high-quality stocks at discounted prices, significantly boosting their long-term returns. This example illustrates how anticipating market corrections and being prepared can turn potential setbacks into opportunities. Example 2. Building an emergency fund. Another example Robbins provides is the importance of having an emergency fund. He tells the story of a family who faced unexpected medical expenses. Because they had anticipated the possibility of such emergencies and saved 6 months' worth of living expenses, they were able to cover the costs without going into debt. This foresight not only provided financial stability but also peace of mind during a stressful time. This example highlights the power of anticipation in ensuring financial security and resilience. Example 3. Planning for retirement. Robbins discusses the significance of planning for retirement well in advance. He shares the story of an individual who started contributing to their retirement account early in their career. By anticipating the need for a substantial retirement fund and taking advantage of compound interest, this person was able to accumulate a significant nest egg over the years. This proactive approach allowed them to retire comfortably and pursue their passions without financial worries. This example underscores the importance of early and consistent retirement planning. Example 4. Anticipating tax implications. Robbins also emphasizes the need to anticipate tax implications when making investment decisions. He recounts the experience of an investor who frequently traded stocks without considering the tax consequences. This led to high short-term capital gains taxes, which significantly reduced their overall returns. By anticipating these tax implications and shifting to a long-term investment strategy, the investor was able to minimize taxes and maximize their wealth. This example demonstrates how foresight and tax planning can enhance financial outcomes. Example 5. Adapting to economic changes. Finally, Robbins highlights the importance of anticipating and adapting to economic changes. He tells the story of a business owner who closely monitored economic trends and anticipated a shift towards digital commerce. By investing in e-commerce infrastructure and digital marketing early on, the business owner was able to stay ahead of competitors and thrive during the transition. This example illustrates how anticipating economic changes and being proactive can lead to sustained business success. Unshakeable provides valuable insights into the power of anticipation in achieving financial success. By preparing for market corrections, building an emergency fund, planning for retirement, anticipating tax implications, and adapting to economic changes, Robbins shows how foresight and proactive measures can empower individuals to navigate financial challenges and seize opportunities. Through these real-life examples, he demonstrates that anticipation truly is power. Lessons number 5. Few new terminology. Tony had shared few terms and added few vocabulary to my dictionary, which I am sharing with you. Hedge fund, a private fund available only to high-net-worth investors. Mutual funds, a public fund available to anyone. Correction, when any market falls by at least 10% from its peak. Historically, the average correction has lasted only 54 days, less than 2 months. 80% of corrections don't turn into bear markets. Bear market, when a market falls by at least 20% from its peak. Bear markets don't last. Tony described the professionals who manage the mutual funds. They aced their math tests in high school, studied economics and accounting, and earned MBAs from the world's best graduate schools. Many of them even wear suits and ties. and they're dedicated to researching and selecting the very best stocks for their funds to own. Antidote, a medicine taken if given to counteract a particular poison. Perilous belief, full of danger or risk, exposed to imminent risk of disaster or ruin. Impenetrable language, impossible to understand. Wall Street Journal had reported that there are more than 200 different designations for financial advisors, including financial consultants, wealth managers, financial advisors, investment consultants, wealth advisors, and private wealth advisors. Parking ticket example: Bank of America had to shell out $415 million in fines for misusing its customers' assets. Big deal. In one 3-month period in 2015, the bank earned a profit of $5.3 billion. That's in just 12 weeks. For companies this rich, those pesky fines are just a routine cost of doing business, the equivalent of you or me getting a parking ticket. There are some certificates that the best financial advisor should have: RIAs, Registered Investment Advisor, CFP, Certified Financial Planner, CPA. Asset allocation is simply a matter of establishing the right mix of different types of investments, diversifying among them in such a way that you reduce your risks and maximize your rewards. Lost decade is between 2000 and the end of 2009, because the S&P 500 was essentially flat despite its major swings. So why should I roll the dice by having high-risk surgery? This time it's different. The 4 most expensive words in investing: bleak, lacking of vegetation and exposed to the elements. Real estate investment trusts. They provide a no-hassle, low-cost way to diversify broadly, both geographically and across different types of property. Tony Robbins introduces several key financial terms that are essential for understanding and navigating the world of investing. Let's explore some of these terms through deep examples to see how they apply in real-life scenarios. Fiduciary. Robbins emphasizes the importance of working with a fiduciary, a financial advisor who is legally obligated to act in the best interest of their clients. He shares the story of an investor who initially worked with a non-fiduciary advisor. This advisor recommended high-fee mutual funds that benefited the advisor more than the client. After learning about fiduciaries, the investor switched to a fiduciary advisor who provided unbiased advice and recommended low-cost index funds. This change significantly improved the investor's returns and trust in their financial planning. This example highlights the critical role of fiduciaries in ensuring that clients receive advice that truly benefits them. Index funds. Index funds are a type of mutual fund designed to replicate the performance of a specific market index, such as the S&P 500. Robbins explains how these funds offer a low-cost, low-risk way to invest in the stock market. He tells the story of an investor who was frustrated with the underperformance and high fees of actively managed funds. By switching to index funds, the investor was able to achieve market average returns with significantly lower fees. Over time, this strategy led to substantial growth in their investment portfolio. This example demonstrates the advantages of index funds in providing a simple and effective investment solution. Asset allocation. Asset allocation refers to the strategy of dividing investments among different asset categories, such as stocks, bonds, and cash, to balance risk and reward. Robbins shares the story of an investor who initially had all their money in stocks. During a market downturn, they suffered significant losses. After learning about asset allocation, the investor diversified their portfolio to include bonds and cash. This diversification helped cushion the impact of market volatility and provided more stable returns. This example illustrates the importance of asset allocation in managing risk and achieving long-term financial goals. Compound interest. Compound interest is the interest on an investment that is calculated based on both the initial principal and the accumulated interest from previous periods. Robbins explains the power of compound interest through the story of 2 friends, Sarah and Emily. Sarah started investing $100 a month at age 25, while Emily started at age 35. Despite investing the same amount each month, Sarah ended up with significantly more money by retirement due to the extra decade of compounding. This example highlights the importance of starting to invest early to maximize the benefits of compound interest. Dollar cost averaging. Dollar cost averaging is an investment strategy where an investor consistently buys a fixed dollar amount of a particular investment, regardless of its price. Robbins illustrates this concept with the story of an investor who used dollar cost averaging to invest in a volatile stock market. By purchasing shares at regular intervals, the investor was able to buy more shares when prices were low and fewer shares when prices were high, ultimately lowering the average cost per share. This strategy helped the investor build a substantial portfolio over time, demonstrating the effectiveness of dollar cost averaging in managing market volatility. Rebalancing. Rebalancing is the process of adjusting the proportions of different assets in a portfolio to maintain a desired asset allocation. Robbins shares the story of an investor who initially had a balanced portfolio but allowed it to become heavily weighted in stocks as the market rose. When the market corrected, the investor suffered significant losses. By regularly rebalancing, the investor could have maintained a more stable and diversified portfolio, reducing the impact of market fluctuations. This example underscores the importance of rebalancing in managing risk and ensuring alignment with investment goals. Unshakeable introduces several key financial terms that are crucial for effective investing. Through real-life examples, Robbins demonstrates the importance of working with fiduciaries, investing in index funds, practicing asset allocation, leveraging compound interest, using dollar cost averaging, and regularly rebalancing portfolios. These concepts provide a solid foundation for achieving financial security and success. Lesson No. 6. The Power of Compounding. The real route to riches is to set aside a portion of your money and invest it, so that it compounds over many years. Never underestimate the awesome power of disciplined saving combined with long-term compounding. The lesson is, don't underestimate the power of compounding. As Darren Hardy wrote a book, The Compound Effect, Tony had shared few examples to elaborate the importance of compounding. Tony Robbins highlights the transformative power of compounding, a fundamental principle that can significantly impact your financial future. Let's explore some deep examples from this section to understand how compounding works and why it is so powerful. Example 1. The Early Investor. Robbins shares the story of two friends, Sarah and Emily, to illustrate the importance of starting early. Sarah begins investing $200 a month at age 25, while Emily starts the same amount at age 35. Both invest until they are 65, but because Sarah started 10 years earlier, she benefits from an additional decade of compounding. By the time they both reach 65, Sarah's investment has grown to approximately $500,000, while Emily's has only reached about $250,000, despite both contributing the same total amount. This example demonstrates how starting early allows your investments more time to grow exponentially, highlighting the incredible impact of compounding over time. Example 2. The Power of Consistency. Robbins emphasizes the importance of consistent investing through the story of John, who diligently invests $100 a month into a retirement account. Over 30 years, John's regular contributions, combined with the power of compound interest, grow his investment to a substantial sum. Even though his monthly contributions might seem small, the consistent addition of funds allows the interest to compound, leading to significant growth. This example shows that even modest, regular investments can accumulate into a large amount over time, thanks to the power of compounding. Example 3. The Impact of Compound Interest Rates. Robbins explains how different interest rates can dramatically affect the growth of investments. He uses the example of two investors, Alex and Ben. Alex invests $10,000 at an annual interest rate of 5%, while Ben invests the same amount at an annual interest rate of 7%. After 30 years, Alex's investment grows to about $43,000, whereas Ben's investment grows to approximately $76,000. This example highlights how even a small difference in interest rates can lead to vastly different outcomes over time, underscoring the importance of seeking higher returns within a reasonable risk tolerance. Example 4. The Snowball Effect. Robbins likens compounding to a snowball rolling down a hill, gathering more snow and growing larger as it goes. He shares the story of an investor who reinvests their dividends and interest earnings back into their investment portfolio. Over time, these reinvested earnings generate their own returns, creating a snowball effect that accelerates the growth of the portfolio. This example illustrates how reinvesting earnings can significantly enhance the compounding effect, leading to exponential growth. Example 5. The cost of waiting. Robbins also discusses the cost of waiting to start investing. He tells the story of two individuals, Mark and Lisa. Mark starts investing $5,000 a year at age 25 and stops at age 35, while Lisa starts investing $5,000 a year at age 35 and continues until she is 65. Despite investing for only 10 years, Mark's early start allows his investments to grow to a larger amount by the time he reaches 65, compared to Lisa, who invested for 30 years. This example underscores the significant advantage of starting early and the opportunity cost of delaying investments. Example 6. The effect of fees on compounding. Robbins highlights how fees can erode the benefits of compounding. He shares the story of an investor who initially invested in high-fee mutual funds. Over time, the fees significantly reduced the overall returns of the investment. By switching to low-cost index funds, the investor was able to keep more of their returns, allowing the power of compounding to work more effectively. This example demonstrates the importance of minimizing fees to maximize the benefits of compounding. Unshakeable provides compelling examples to illustrate the power of compounding. By starting early, investing consistently, seeking higher returns, reinvesting earnings, avoiding delays, and minimizing fees, Robbins shows how compounding can significantly enhance financial growth and lead to substantial wealth over time. Through these real-life stories, he underscores the transformative potential of this fundamental financial principle. Lesson No. 7. Happiness is associated with giving. Why we need to win. The human brain isn't designed to make us happy and fulfilled. It's designed to make us survive. When we're winning, our bodies release chemicals called endorphins, so we feel euphoric and don't want to stop. When we're losing, we don't want to stop either, since we crave those endorphins and also want to avoid the emotional pain of losses. Fulfillment is associated with two principles: growth and giving. Remember that money doesn't change people. It just magnifies who they already are. Real wealth is emotional, psychological, and spiritual. If you're financially free, but you're suffering emotionally, then what kind of victory is that? Nothing enriches us as much as helping others. The lesson, our happiness is linked with contribution to others. Tony had mentioned about the happy chemicals, which was one of the books that I have read 2 months back, and I encourage everyone to read it. Meet your happy chemicals. Again, this may be related to confirmation bias that I am right in my selection. Finally, you have to read the book to understand the rules of the finance game. I had just shared the non-financial lessons, still the best advice in the book, which applies to everything in your life. Sow the same seeds as the most successful people, and you'll reap the same rewards. That's how you'll achieve financial mastery. By studying the right models, you could learn in a week what might otherwise take you a decade. Example 1. The joy of philanthropy. Robbins shares the story of a successful entrepreneur who, despite achieving significant financial success, felt a sense of emptiness. Seeking deeper fulfillment, the entrepreneur began donating a portion of his wealth to various charitable causes. He funded educational programs, supported healthcare initiatives, and contributed to environmental conservation efforts. Through these acts of giving, he discovered a profound sense of joy and purpose. This example illustrates how philanthropy can transform one's life, providing a deeper sense of satisfaction and happiness that goes beyond material wealth. Example 2. Volunteering and community engagement. Another example Robbins provides is of an individual who found happiness through volunteering. This person, feeling disconnected and unfulfilled in their corporate job, decided to volunteer at a local shelter. By dedicating time and effort to helping those in need, they experienced a renewed sense of purpose and connection. The relationships they built with the shelter's residents and staff brought immense joy and fulfillment. This example highlights how giving time and energy to support others can lead to a richer, more meaningful life. Example 3, the ripple effect of generosity. Robbins discusses the ripple effect of generosity, where one act of giving can inspire others to do the same. He tells the story of a community leader who started a small initiative to provide meals for the homeless. This act of kindness inspired others in the community to contribute either by donating food, money, or their time. The initiative grew, creating a network of support that significantly improved the lives of many people. This example demonstrates how giving can create a positive chain reaction, amplifying the impact and spreading happiness throughout a community. Example 4, personal growth through giving. Robbins also emphasizes that giving can lead to personal growth. He shares the story of an individual who, after experiencing personal loss, decided to channel their grief into helping others. By supporting a cause related to their loss, they found healing and personal growth. This journey of giving not only helped them cope with their grief but also brought a sense of accomplishment and happiness. This example shows how giving can be a powerful tool for personal development and emotional healing. Example 5, corporate social responsibility. Finally, Robbins highlights the importance of corporate social responsibility, CSR. He shares the story of a company that integrated giving into its business model. By committing a percentage of profits to social causes and encouraging employees to participate in volunteer activities, the company fostered a culture of generosity and community engagement. This not only improved employee morale and job satisfaction but also enhanced the company's reputation and customer loyalty. This example illustrates how businesses can benefit from incorporating giving into their core values, creating a positive impact on both their employees and the broader community. Unshakeable provides compelling examples of how giving can lead to greater happiness and fulfillment. Through philanthropy, volunteering, inspiring generosity, personal growth, and corporate social responsibility, Robbins demonstrates that the act of giving enriches both the giver and the receiver. By focusing on the needs of others and contributing to the greater good, individuals can find deeper meaning and joy in their lives. Thank you for listening. I hope this content is useful to you. If you like this kind of content, please like, share, and subscribe to our channel to support our team.